Well, good day, everybody, and thank you for joining the Next Wave webinar series. We're delighted to have you here today. Today, we're going to be talking about some considerations related to investing in a downturn, looking at down rounds and managing CVC portfolio companies through this market uncertainty. We have an outstanding panel to join you, and I will introduce them or allow them to introduce themselves in just a few minutes. But first, we'll start with just a little bit of industry context about the topic and what we're covering. Let me just start by first asking you to take note of this disclaimer that we are not dispensing with investment advice purely for informational purposes, and you can read those details quickly. The reason that we're going through this material here is that it is important for us to be able to understand how we're going to respond in this current environment. At any rate, I'll assume that you're looking at the slide that has the some market context for this. And essentially, you know, if you've been watching the paper, the news, the media in any way, shape, or form, you can see lots of different headlines about this being, you know, is this a crisis or is this an opportunity? And we'll talk with our panelists this morning or today and get their opinions about this. But, you know, there's been a lot of talk about this, and I would just say, you know, if you think about it, doesn't the market feel a little bit different today than it was like 4 months ago, 3 months ago? And so we're seeing, you know, more signs of recessionary or, you know, market turbulence as capital markets have changed and tightened significantly. We're starting to see some activities around down rounds, around a lot more of a shift towards investors you know, taking the time to do rounds very seriously, considering the options with portfolio companies. So, some market context for this, what we see overall is that the deal volume is down significantly, like, you know, 14% over last year. We're still kind of working our way through, you know, the increase of activities that we've had over the last year or so. We're also seeing a shift towards earlier stage companies as kind of the target investment. In the most recent survey that we looked at, over 58% of all financings were in the Series A area. And we're starting to see more extension rounds come about where companies are doing various bridges or raising you know, new rounds at the same valuation as the last cycle. Where we are seeing down rounds is particularly in the later stages, and those seem to be where the down rounds are hitting first. And we're also seeing some signals with respect to, you know, investment terms, you know, more senior liquidation preferences and things that are kind of an indication that investor confidence is not where it used to be. Other thing that we're seeing is that in terms of the equity to debt spectrum is something that we got from the Andreessen Horowitz website, which shows a number of different options that investors may choose as they look at how to their financing options, moving from kind of the typical equity terms all the way to other things like non-convertible debt, and just deploying a full scope of various options. With respect to the options that portfolio or that CVCs have as we walk through this market environment, well, there's kind of three different areas that we look at. One is, you know, the role of the chief investment officer or COO in a portfolio company is something that we've seen over the last few years. The form that this role may play may vary from organization to organization, but what we often see is somebody who's in a role to really look at the whole portfolio and review the status of each company, look at your guidelines, look at your kind of way of managing the portfolio. And we'll hear a little bit about that from our panelists today. And then the usual things that you do with respect to managing the portfolio, looking at their overall health, and, you know, managing your relationships with the other syndicate members and so on. All of this is ways to look at what you do as a portfolio, you know, in terms of managing your overall portfolio. I think maybe next is to introduce the panel. I would just like to maybe start with having the panelists each introduce themselves. We have three outstanding panelists with lots of experience and expertise. So why don't we start with Tammy, if you could go first and tell us a little bit about your program and when you were established and what your role is, and and then we'll go on from there.
So I'm part of Intel Capital. I've been with the group for almost 23 years. I joined before it was even called Intel Capital. That's how long I've been with the group. The group has been around 3 decades. We've invested over $13 billion in more than 1,500 companies in 57 countries. And we've had more than 660 exits. At least that was the stats from a year ago. So I'm sure those numbers have gone up. We are set up as a BU within the broader corporate strategy group of Intel. So, unlike VC firms that are completely separated, by themselves, et cetera, we are within Intel Corporation, the larger company. We typically invest between $300 to $500 million a year as a group. It has varied over time, but that's been about our track record over the past 2 decades. And we typically, when I first got to Intel, we would do like kind of between $1 to $3 million investments, and we would take a board observer role. That was kind of our sweet spot. But in the last decade, we've actually switched to a bit more aggressive approach where we're leading, investing between 5 to 15 million in Series A, B, A or Bs, and we will definitely look to take board seats. So we're way more active in sort of how we view our role with startups. We focus on investments in innovation, driving compute in cloud, silicon devices like mobile and frontier, which we consider things like robotics, autonomy, and healthcare as part of our frontier efforts. I'm specifically responsible for tracking investments around the quantum computing space, and I do look at other areas since I've been here so long around robotics, MEMS, RFID, whole host of other areas that I get tapped for just expertise and knowledge, having been around as long as I have been. But I also help out on a number of our older vintage year companies, so companies we've invested in, longer than we should still be in those companies sometimes. And then also I help with complex situations. So one example would be Intel spun a business out and sold it to a startup. And so then I kind of helped manage that process, actually took a board observer role, and that company eventually went public. So that was a pretty turbulent process, but it was actually a really nice exit for us. I'm also involved with training within Intel Capital. And in fact, in 2021, I was asked to think about helping prepare people for a tougher economic environment. We saw the lofty prices that deals were getting done at, and we felt very strongly that we were due for a correction. So we actually ran a series of mock negotiations around what do you do when you're faced with a pay-to-play cram down? And we ran those in 21 into 22, and we continue as an organization to kind of be prepared and ready for that. I've actually gone through at least 3 market downturns. I kind of think there might have been a 4th one in there, the dot-com bust, the 2008, and then what I believe today is that we're going into a downturn market. So, and again, there were some little bubbles along the way during the last 2 decades. And sort of the final thing on my introduction is that I don't think that cram downs and pay to plays only happen during market downturns. I've actually had to deal with them even in the last two years. So there's a lot that goes in there, but you definitely see those types of concepts and terms way more during market downturns. So that's it. I've covered, I think, all the points that you guys asked us to cover. So.
Great. Well, thank you, Tammy. That's wonderful. And now I'm back again. I missed part of your introduction. So thank goodness we know one another. But why don't we move on to Dusty next, and we'll continue with introductions. So.
Yeah, sure. So my name is Dusty Lieb, and I had the investment team here at Echo Health Ventures. Echo Health Ventures, we were established back in late 2016 as a way for Blue Cross Blue Shield plans. At the time, there were 2 of them, to get scale in their investing units. So we were doing this off of the multiple Blues. We're doing this off of their own balance sheets, which was using venture as a tactic to access the innovation ecosystem. In 2016, we spun out to become a separate entity. I'd say we are not organized as a typical kind of GP LP entity. So while we are separate, we're not a business unit, for example. We are wholly owned by the Blue Cross Blue Shield plans that we invest on behalf of. They actually kind of view us as like a shared box on the org charts of what are now 4 BCBS member plans, which are CAMD in the Pacific Northwest, Blue Cross North Carolina, BCBS Tennessee, and Arkansas. So we invest on behalf of all of those, again, using venture as a tactic to help these, traditionally fairly large immobile organizations access the innovation ecosystem. In terms of how we think about our work, we have a dual mandate. That mandate is for both strategic and financial return. And I'll tell you, it probably skews much more to the strategic than it does to the financial. When I go to report to my investment committee, which is made up of the CEOs and CFOs of those member health plans, or my board, which is made up of the board members of those member health plans, their first questions always tend to be around the strategic as opposed to the financial returns. In terms of our program and how we operate, we typically tend to look at check sizes of 10 to 20 million. Because our mandate skews towards strategic, we don't limit ourselves in terms of what types of securities we can invest in. So we will do anything from seed stage investment through traditional venture, growth equity, and pre-IPO rounds, through leverage buyouts. We will not lead the leverage buyouts. We think we bring a complementary skill set. We will always be in kind of the second chair there behind the private equity groups that have those credit teams. Just with the general threshold being that we need to see a path to get to around $10 million of equity commitment at least. That's because, as Tammy mentioned, we similarly are very active investors. So our portfolio consists of about 30 companies that we've invested in since 2016. We typically like to take board roles and at the very least board observer seats. And so just from a portfolio management perspective, we like to skew towards those larger equity check sizes relative to our fund. And I'll put fund in quotes, and we look to do around 4 to 8 of those types of deals every year. My role on the team, as I said, is leading the investment team. Echo is organized into 3 separate teams. We have an operations team, which I think we're going to talk about a little bit. They are in charge of being the interface to reporting with those member organizations. We have the investment team, which is made up of people with similar backgrounds to me. So I did a couple tours at Harris Williams and Company. I spent 2008 sitting at the private equity arm of Fidelity, which was a similar strategic type of investor investing off of the Fidelity balance sheet, and joined Cambia back in 2012. So lived through 2008, and actually had to go back to my former investment bank employer humbly with my cap in hand once all the dust settled in 2009. So I think that's it for me.
That's great. And Dusty, you reminded me when you mentioned this. I joined Intel Capital a few years after Tammy had been working there. And I remember at the time, this is maybe 2005 when I first started working with the organization, everybody still had the dot-com bubble bursting kind of top of mind. And that really guided a lot of our activities and concerns that we had through the 2008, 2009 downturn. And I noticed recently when I was mentioning those headlines, a lot of people are kind of still going back and kind of remembering, the actions that folks took, 23 years ago, roughly when the dot-com bubble burst. And so there's a long memory on these things, and reputation is so important. So I think, there's kind of some collective interest in addressing these things, as well as, just a lot of memory that we want to tap into. And in terms of the expertise that we have, our next panelist is particularly well-versed in this. So I'll let Ian introduce himself and talk a little bit more about his background and some of the things that we'll talk about.
Sure. Thanks, Lee. Appreciate it. My name is Ian Goldstein. I'm a partner at Fenwick & West based in New York City. For those who aren't familiar, Fenwick is one of the sort of very small number of premier law firms based in Silicon Valley that focus on the representation of venture-backed startups, in the tech and life sciences space at sort of all different stages. And the larger institutions, both VCs, strategic investors, and strategic acquirers, that sort of partner with that ecosystem in a variety of different ways. And ultimately, that's what I do. I spend about half my time representing venture-backed startups that all of you invest in. And then the other half of my time working with VCs and primarily strategic investors. So I lead our CVC practice here at Fenwick, and I co-lead our startup practice here at Fenwick. I've been a lawyer doing this for over 25 years. So like Tammy and Dusty, I've seen the other downturns in .com one. I was actually the general counsel of a .com company and saw sort of both sides of that spectrum, having raised a bunch of money for the company that I was with in 1999. We ran a wonderful Super Bowl ad in early 2000, and then we saw sort of all of the other side of that shortly after the .com bubble burst. And then I went back to law firm land and continued to focus on the representation of venture-backed startup companies and corporate investors. So, as Lee mentioned, I sort of have, a pretty wide aperture from what we get to see at Fenwick. We represent over 50 corporate venture investors from, big tech companies to big pharma to, all different types of technology, life sciences, and other industry companies in between. And we have the benefit of also representing over 2,000 venture-backed startups at all different stages and in all different industries. So we see sort of corporate venture from a really broad spectrum, and we see sort of, we have a good lens on what is going on in the ecosystem, what types of structures, what types of transactions work from a startup perspective and also from an investor perspective, and what, either doesn't work or is problematic. So look forward to sharing some of those learnings with you here today.
That's great. Thank you, Ian. And I was thinking that's probably a good segue into one of the questions that I wanted to ask first for the panel is, so is this a time for crisis or is this a time for opportunity? And so I'm curious if you could just tell me a little bit of what's your perspective on downturns. You've each been through lots of them. So, what are the implications of this for your portfolio strategy? Are you shifting what you're doing? Is this a good thing or give me a sense for how this is playing out and what you're doing to apply some of the learnings that you just referred to from prior downturns. So somebody want to talk first and kind of give us a sense for that?
Sure. Look, I think as investors, it's just important to be constantly factoring in the economy, not just like how the startup's performing, like are they getting reports out in time, things like that, but it's what's going on in the global economy all the time. And just like COVID, some companies really suffered, some companies actually did really well. We're going to see the same kind of dichotomy happening here as well. And, the one, I'm not saying this is a positive, but the one thing that's helpful is when we go through economic downturns is that the I don't like to use the word power, but there's this power shift or this ability for, in the last few years, entrepreneurs really had a lot of ability to drive prices up on the deals, right? And to places that we all were recognizing was probably not good from an investment standpoint. And even from a company standpoint, when you set a valuation too high, and if you can't just, create enough revenue business to support that, it's not going to be good for the next round, regardless of an up or downturn market. So there's kind of like, I feel like there's this resetting and re-rationalization, like things have gotten too entrepreneur friendly and it's kind of shifting back toward investor friendly terms, in my opinion. And so I think that's kind of a good thing in a sense. But now it's also going to be, there's going to be a painful period in the sense that, like, if somebody needs to raise follow-on fundraising and they have a high valuation from the prior round, there's a lot of like education, expectation resetting. So there's going to be a lot of this kind of emotional stuff that everybody has to manage through. And so the key to me is that it doesn't have to be a crisis. If you just like, don't sit back and wait for stuff to happen, start having the conversations with the investors, with the CEO, like what's going on, making sure that you're managing your burn, all of this. I mean, it's just all the basic things, but just finer pointed because of the fact that the global economy is feeling shaky, right? So I think it's, like I said, I think there's a lot of good things that are going to happen out of this, but it's just going to be a rough period.
That's great. And so, Dusty, I'm curious what's with you with Echo, and you might want to put some context in this in terms of what stages you invest in, and if there's any differences in your approach to this downturn, based on the kind of companies you have in your portfolio?
Yeah, well, because we're stage agnostic, we tend to be a little bit more opportunistic around stage. And so, had some in, I would say 16, 17, 18, really focused on the growth equity market where we saw some alpha in the market. And then as the growth equity market took off to certain heights that were not sustainable, not well priced, we moved into earlier stages and actually looked at a few other LBOs. Which is kind of relevant to the conversation here. I mean, in this environment, I kind of reiterate what Tammy says. It is a risk to your portfolio. I'll talk a little bit about how we think about mitigating that, but certainly an opportunity from a sourcing perspective. There's a lot of data out there that pretty firmly shows that these vintage years following these downturns tend to be outperformance types of years, right? Because there's less capital. Now there's less capital flooding into the market. Pricing has adjusted, in the venture world, entrepreneurs' expectations have changed. I would say probably certainly much more than in 2008, 2010, though, we have a significant dry powder overhang, right? That will probably keep things a little bit more elevated. We are not in the kind of environment where CalPERS says, I'm not going to fund capital calls, and what do you want to do about it, right? Yeah. So we still, funds are still able to raise, and they have been raising. And so that I do have questions about, what kind of equilibrium we're going to reach. And I like to be a little bit opportunistic in asset classes as we think about sourcing in this kind of environment. In our portfolio, again, I've just probably reiterated what Tammy said. You don't want to fall behind it. I think we were pretty well on the sidelines for new deals starting in late 21 and most of 22, which isn't to say that, we got a lot of deals close to the finish line, but pricing and expectations weren't there, and we were not willing to flex on our underwriting standards. At that same time, we were saying, look, certainly this world economics are hard to predict. I think this asset pricing change that we're experiencing now, I don't think was. And so, best thing to do is to try to get ahead of that. We started thinking about remediation priorities in the portfolio in mid 21 and saying, like, if you have the ability, go out and raise money to weather the storm, and enough to weather a storm with this cheap and available capital through 24, 25, if you can. And if you're in a position of strength, you could do that. And we will see. I think that's the big ambiguous piece of this for me is that, I'm not quite sure how long the storm lasts. I don't know when this all shakes out and capital becomes maybe a little bit cheaper if we're in this for a very extended amount of time. The data would indicate we could be.
Okay, so that's helpful. And we know that Intel is a kind of classical tech company. Echo Health, in the healthcare area, it invests broadly in healthcare. Ian, are you noticing across the various sectors any noteworthy differences in terms of the types of companies or the way that this is playing out in terms of different sectors? Like renewable energy and sustainability are, I think, still running quite hot. But are there things that you see either geographically or in terms of the sectors that are playing out differently in this current recession or current downturn, whatever you would call it?
I think the answer is a little bit, but not sort of broadly. I do think sort of, clean tech does seem to be sort of an area of strength at the moment. But generally, I would say that what we're seeing across a broad range of sectors is still sort of a return to the kind of pricing and other fundamentals that Tammy and Dusty mentioned. So, we were, it was sort of the highest of highs in 2000 and 2021, or 2020 and 2021. And so, adjustments on price and other terms, and also just like fundamentals and market practices, right? Tammy mentioned, it was a very company founder friendly environment for quite a long time. And that is sort of part of what's rebalancing. It's not just price, right? But it's sort of coming back to, some relative balance between the investor class and the company management class to sort of get to a place that is just, hopefully a better equilibrium. It helps these companies grow. And it's really, the question is like, where is that pendulum swinging right now, right? In some cases, and I'm sure we'll sort of get into this in more detail. In some cases, some financings optimize that, right? We could do a down round. We can do a restructuring that really optimizes the company for future growth and success. And that's great. And that's what should be the objective. And in other cases, it could be that a company, existing investors and stockholders get squeezed too hard, or too much structure gets built into a deal. And that doesn't necessarily, line itself up for future success. All topics that we'll cover a little bit more, but, we are seeing sort of some variations among industries, but generally a broader theme of, obviously less investment overall in terms of number of deals, downward pressure on pricing, and, some resetting of terms across a broad range of companies.
That's great. And so that's a nice segue into a question that I want to start to get into is, so from a portfolio management standpoint, what steps have you taken to respond to this market uncertainty? And you've already kind of alluded to many of these things in terms of what you're doing to protect your investments and support your portfolio. But you've been through this before. You've mentioned, kind of having a sense of your playbook, if you will. But maybe you could tell me a little bit, more specifically, how do you approach these things? What are the things that you've done in terms of working through your portfolio company? Maybe give some examples of the types of things that you've started to do, because you've definitely both talked about proactively addressing this from a portfolio standpoint. And Ian, we'll come back to you on this, because I know there's times when you've been brought in to address specific situations and to help train investors on some of the things to look for. But so maybe Tammy, you've talked a lot about these things. What are the things that you typically see that you're starting to do in terms of managing the portfolio through this?
A lot of it's just having good practices all the time. So, we within Intel Capital, I think we have really good practices about looking at our portfolio, looking at companies that might be in distress, and kind of trying to figure out what to do. Like, I think when I joined Intel in 2000, we didn't have necessarily good practices, so we were kind of learning through that dot-com bust. Like, what are good practices? Like, one of the things we did was we looked at the health of the portfolio and really focused on the ones that were, in trouble, and then try to get resources, experienced people around those to try to work through those. But now that, we've gone through a few bubbles, like, I feel like we have a good programmatic way of doing these things. So I think the biggest new thing we're doing right now is just making sure that we're relaying to, especially the newer or junior investors, hey, make sure, like, it's kind of like reminding people, watch the cash burn, get the cash burn down, understand your runway, understand the capital capacity of the people around the table. If they don't, it doesn't matter if we have money, if nobody else around the table has money, are we really, prepared to put the bill to kind of get them to their next milestone? So it's kind of just reminding people and just being thoughtful about that. So that's on our existing portfolio. On new deals, it's hard, but I appreciate it. Our investment committee is taking a tougher stance on terms, because I'm going to steal the thunder of one of my partners in Intel Capital, but he uses the analogy of sending somebody to run a marathon and strapping 100-pound pack on their back, right? And if we don't want to do that. So we want companies to be nimble. We want them to be able to get the things done that they need. So on the new investments, we're just going to be, the scrutiny about valuation is very is tougher right now, because we know we're in a place where we can be tougher. So again, existing portfolio stuff, just continually to manage burn, understanding. And if you don't have good processes in place, go back and start looking at your portfolio, like, which are the healthy companies ones, which aren't, and do stuff like that. And then on new investments, just, taking a tougher line on valuation. And then, as I mentioned, we did in 21, which is interesting to hear that Dusty was also, they were starting to think about the same thing. We specifically started doing training to remind people and get them start thinking about, it's a multifaceted issue and a multifaceted negotiation that happens when you get into these tough financings. So getting prepared and educated about the situation, not just the company, but your co-investors, is so important. So.
And it sounds like you've done a lot to educate your team internally, and similar to some of the things Dusty referred to. I'm curious for both of you, have you had to, we got a whole lot of new first-time entrepreneurs as well that probably haven't been through a downturn. So how does this play out when you start, having these conversations with the portfolio companies and the other investors around the table? Comments on that?
I'll let Dusty comment first.
Yeah, I think it depends on their perspective and what they've been through, and as first-time entrepreneurs, ensuring that you're managing expectations appropriately. And a lot of these entrepreneurs, if they were first-time entrepreneurs in a certain asset class going into the last 5 years, they get trained to believe that capital is cheap. They also get trained to believe that that growth at any cost is what drives maximum valuation. It's a byproduct of what the public markets did. It's a byproduct of some of the large growth equity-ish hedge funds coming into the space and funding a lot of deals with very cheap capital, right? And so they were oriented to think about the world that way. And then I think one of the most important mitigation factors that Tammy hit on here was, now we're in a very different environment, and it's a lot harder to flip that P&L from a growth-oriented P&L to one that has to have reasonable cash burn and bridge to 2025. And so there's a lot of, in the situations I'm involved with, there's a lot of coaching that goes into that, right? Where it said, well, you said in mid 2020, like this is how we needed to orient the business. And now you're saying at the end of 21 that this is how we need to orient the business. That's a lot harder after we made that jump in 2020. So, I just go back to having these disciplined processes all the time, right? And ensuring that you're staying on top of that.
Yeah, so it sounds like there's a lot of work to be done around communicating and reinforcing the expectations, which may change over time. Tammy, you also had mentioned this fundraising climate shifting more towards the investors. And I know you're from prior discussions with both of you, you're that you normally don't use a lot of really specialized terms or ROFRs or things like that you might see ordinarily to begin with. But I'm curious, what are the shifts that you're seeing in terms of changes in terms, or things that are more investor friendly? I don't know, Ian, if you have a perspective on that from kind of looking at the whole industry. I know Fenwick's also done some data analysis of that, but are we seeing a shift of terms already?
So I wanted to go back. I wanted to go back to the earlier question, and then we'll go to the terms, which is about, talking to the entrepreneurs about this shift. And I will tell you, it's not fun, because a lot of times the entrepreneurs will say, well, so-and-so just raised, such amount of money just 3 months ago, and some ridiculous valuation, some ridiculous raise amount. So first-time entrepreneurs, this is really kind of almost painful. There's some ego, there's pride, there's some confusion, like, I don't understand, why could they raise that and I can't get it now, right? So I'm just there. It's a more delicate dance and conversations that you have to have nowadays. But it's the right conversations, and it's the right time to do it, right? This is the time to do it, is because you have a market environment that kind of supports your ability to kind of get people to kind of come back to earth in terms of their expectations on valuation and raise amount. So that's on that. On terms of deal terms, at the end of the day, I think a philosophy that we try to abide by at Intel Capital is price the deal properly. And the closer you can price the deal properly, then you don't have to do all these, senior liquidation preference, 2x senior liquidation preference, all that crazy stuff. Like, sometimes people think, we'll keep the valuation high, but we'll put on all these crazy terms so that if the exit's bad, we can still make out. But the problem is that all that does is make it look worse, right? If you have to raise more money, the new investor is going to look at that and go, like, that thing looks horrible. But sometimes pricing the deal right means doing a crown down or pay to play, right? Or, compressing, taking a lot of dilution. So from my perspective, it's, if you always price the thing properly, you're going to have less need for all of these special terms. But when you start getting, when stuff starts getting kind of crazy, like you're on round series H, right? All of a sudden, you're going to see things like senior liquidation preference and higher multiples and stuff like that, right? So I think we're kind of like maybe a few months into things getting rough. But I'll be curious to hear if Ian's seeing a pickup on any of these kind of change in terms.
Thanks, Tammy. And I agree with all that. I think, there stress the importance of getting to the other side of a financing and getting to a place of, call it sort of like simplicity as best you can without having, tiers of liquidation preference, multiples, participation features, extra heavy governance. All of those things are, to sort of, to the way Tammy's colleague described it, right? There's sort of weight on the back of a company as they move forward. And certain companies and certain situations might require some restructuring. But with the goal of hopefully getting to the other side of that restructuring in a way that balances the interests of new investors, existing investors, management, and employees, and sets the company up well for success going forward. We are seeing, an uptick in senior preferences, a little bit of an uptick in participation features. Some of that is in the data, some of it's not in the data, and we're seeing it in sort of like bridge rounds and other things that don't sort of like lend itself to sort of the data that we and others publish. So we are seeing some of that structure come to play there. It's more frequent in maybe more distressed companies and with less sophisticated investors who might be leaning into situations, more aggressively, let's say. Again, to continue the analogy, like putting more weight on the company's success going forward. So my favorite example of a deal recently that I did for one of my company side clients that was sort of exemplary in terms of the pros around the table was a biotech company where there was sort of an A round at a certain price, a B round 50% up from the A round, and then a C round that dropped had to drop the valuation of the company below the A price. And real pros around the table on the investor side, both new investors and existing investors, a really sophisticated management team. And after some back and forth, everyone just realized that it was just in the best interest of the company to keep this simple. They did the down round, they waived anti-dilution rights, they didn't add a lot of complexity to the cap table, they kept the A, B, and C flat in terms of liquidation preference and no multiples or participation features on top of that, and they moved on, right? And the company is so much more successful now because of that, and doesn't have that weight on their back as they move forward in building their business. So that was just a recent example of a bunch of pros around the table who are really experienced getting to a good end game.
That's great. Dusty, anything to add to that? Any comments on that?
No, I think that's well put. I mean, our philosophy at Echo is price the deal appropriately, right? I think that's much better than trying to use structure as an instrument to bridge the gap.
Yeah. So let's talk a little bit more about down rounds. So, there's a range of these, from the more simple to the more complex. Can you talk through maybe an example of a more complex one, Dusty? What have you seen in terms of some of the more challenging types of situations you had to address?
Yeah, well, and we haven't seen. I think we're still in the early days of a lot of this coming home to roost, right? And I think that we have, hopefully we prepared the company well for this and saw a little bit of it coming. But I mean, there have been situations in the past. I'll echo what Tammy said. I mean, these types of situations are not specific just to markets like this. Like, we're going to see more of it, but philosophically, when I've looked at things like pay to plays, like a pay to play or some kind of cram down, I'm always trying to do the math on whether on whether the asset is really it has the underlying strength to turn the corner, right? Because I almost view them sometimes as bridges, right? The same way you might view like a bridge note. And probably one of the more complex situations I was in was probably 10 years ago. and we were in trouble with a provider practice that we ended up with a pretty clean cap table with the provider practice. So not a broken balance sheet or cap table. However, the provider practice got sideways with a very large contract. And we ended up putting in a very kind of punitive pay to play that involved a pull through. Now, the thing you have to be careful with there is obviously cramming down a lot of common investors. And so you need, Ian, you're probably the best one you're the best one to opine on this. I'm always very wary of what I do in those situations to ensure that it is priced appropriately. And this is the only capital that we can get, and that we get very good legal guidance, because those are the situations where you are opening yourself up as exposure to exposure as a board member, legal exposure from the common shareholders. We ended up funding it for doing it this way for probably 9 months before we instituted kind of a formal wind down. So had I done the calculus up front and said, is this asset worth going through all of these iterations? The answer to that was probably not. But there are certainly assets where bridging that gap with these types of structures, it can be useful.
Yeah, I'll just jump in and
Yeah.
lend some quick thoughts on what Dusty just said. It is, you really do have to be mindful of those more sort of complicated down rounds where there's cram downs and pay to plays and things that really sort of wash out smaller investors, common stockholders, employees. There's a lot of sensitivity. Often what is happening is they're often inside rounds, not always, but often they're inside rounds, or at least there's heavy insider participation. And it's really important to make sure that company counsel is there in the boardroom, guiding the board members and giving good guidance. Because if there's in any of these situations, there's some risk. But in particular, if there's a lot of inside participation and those insiders are also in the boardroom, then you have, real risk. And you want to make sure that, management and counsel are there thinking about that. And there are various risk mitigation tactics that can be used to try to create as much fairness as possible in a deal like that. And I don't want to get into sort of too much detail here, but I just sort of, the key takeaway is, if there's a lot of inside participation in a heavily dilutive round, you want to make sure that there's, a lot of good guidance happening in the boardroom from company counsel about how to think about the structure of that deal, what type of, procedures the board needs to go through to make sure that this deal is as fair as possible to all the shareholders, both preferred shareholders and common shareholders, and that there's good sort of process in place for both approval and for getting the deal done to make sure that you're reducing risk as much as possible.
That's very helpful. Thank you, Ian. Okay.
I was just going to add on something, which is simply that, I've had situations where people are like, oh, we don't think this investor is going to come in. Let's just do a pay to play cram down or whatever. And I'm always shocked when I'll be like, it'd be a good idea for us to get the lawyers in to opine on, what needs to be true for you to do something like that. You can't just wake up one day and decide that that's the most expeditious way to do this fundraise. You got to have a fact pattern that says you've tried to do everything else. And you've been forced up against the wall, and this is where you're at. And I think that a lot of times, sometimes entrepreneurs will hear everybody's doing these things, or some investors, I don't know, naively might think that you can just decide to do that. That's not usually the way it works. So, yeah. So
Yeah,
definitely get your lawyers involved. So plug for you, Ian.
Yeah, thanks, Tammy. And just to sort of stress another point, and I think Tammy and Dusty both mentioned this, the importance of communication really early and actively in the process. What we see is sort of, a common and sort of the most risky scenario is when there isn't a lot of pre-planning and a lot of pre-communication happening. And then we've all seen this happen before where, everything, the company thinks everything's going to be great, and then ends up having to do a real messy deal right at the end. And at that point, it's sort of too late to do all the things that you should be doing to make sure you've run a good process, you've sort of stretched yourself in terms of terms and negotiating for the best deal that you can. And, maybe you might have had, the opportunity to have an independent a committee of the board of directors negotiate things with the investor class to sort of reduce risk. There are a variety of tactics that you can do that you won't have time to do if you wait until the company has 2 weeks left of runway. At that point, you're going to create a mess, and that mess is going to have some risk buried in it. So, again, sort of echo the point that Tammy and Dusty mentioned earlier. Early communication and being ahead of the process is really important to sort of building good relationships and creating a better process to hopefully get to a better outcome for a company that might have to do a distress type financing.
Okay, that's great. And there are some questions from the audience that I'd like to just call out, and we have about 10 minutes left. So if there's other questions, kind of now's the time to kind of throw them out there. A couple quick ones to just touch on. So Ian, you mentioned the case earlier about like the biotech down round. What do you see as those types of more difficult situations versus the ones where there's a lot of senior preferences? Is this like a 50-50 mix, or do you see senior preferences feature in the majority of rounds, or is this kind of a minority?
No, I think they're still a minority, but they're in the process of growing up the percentage basis of minority deals, right? We're seeing sort of growth in those minority deals. Not sure where that's going to end, but I think we're still on the up cycle of complex, challenging deals, not yet on the other side of that.
All right. Now I have another great question here from Tony Palchek. So in some of these sticky situations, this might be a corner case, but have you ever seen a person vote one way for his or her board member seat and another way as the investor? So I don't know, that's kind of an interesting kind
Absolutely.
of case. But,
Absolutely.
It does point out this issue. Which fiduciary duty do you respond to?
I've seen this happen a few times where the board member and its firm are recognizing that you might need to vote one way as a board member, but as a firm, as a shareholder, you're going to vote completely different, right? Because a shareholder has a right to vote for its interest. The board member has to vote for the rights of the company and the common stock. So I've definitely seen that. They're very tricky situations. And I've seen it both on the corporate side and on the VC side. Recently, this happened on a VC firm, and I was very proud of them that they actually split. So I think when we have these tricky situations, I wish that more people would actually have two different people. So you have your board member, and then you have somebody separated from the board member from the firm or the corporation being the shareholder, and letting them negotiate and do the right things, right? And so I've seen that. Ian and Dusty, I don't know if you've experienced that, but we definitely, I guess I can say this because it's true. It's the policy is that our board members vote as a board member, but when it comes to the shareholder consent, our board members do not represent the shareholder view from Intel. We've actually split that.
Yeah, that's same with us. I think that's a very useful policy. We've seen that not only in sticky situations. I think as corporates, we have a little bit more exposure to that overall, especially when it comes to dispositions, right? So it's just always very important to ensure that you're maintaining your duty of loyalty, right? Because that's your first and foremost concern as a board member. And then by having that policy in place, I don't have to. We will always talk about how we're gonna vote our shares, right? And it's not the norm, right? By the way, but it certainly happens.
Thank you. So earlier we talked briefly about training, and Dusty, I know you've got a few relatively new people on your team recently, and Tammy, you talked about this earlier. I'd love to hear from both of you. Kind of what are the topics that you've done to kind of level set with your team? And it sounds like some of these are good practices to have in place anyhow. But give me a flavor for how you've approached training and reinforcing the topics that you're trying to drive across your organization, and best practices, things that you're doing. You want to go first, Dusty, or
sure,
or Tammy?
I'm happy to. We are a smaller team. So on my investment team, I think it's a total of 8 people, right? And we train primarily through reps. I love that, Tammy. That kind of the exercise of kind of the mock negotiations for down rounds and cram downs. I might actually have to adopt that if that's okay with you, because I really like that. we have, but we have kind of an apprenticeship model, right? Where we ensure that from day one, our associates are being staffed on observer seats along with board members, right? And to me, that's the most important training that we can give them relative to portfolio company management from a governance perspective. I would say that over the past 2 years, we have had to highlight the difference in the markets. And so where I focus a lot on is training underwriting, right? So we use the apprenticeship model for the governance component, but ensuring that, you know, all of, again, going back to this philosophy of make sure the deal is priced right, right? And make sure you really understand the underwriting that you're doing, and realize that over the past year, we've been in a much higher cost of capital environment, right? So how does that flow through to your underwriting? Like, how do you think about, so like I said, we haven't done a lot of deals the last year and a half. It's waking up now, but that's not to say we didn't get a lot right to the finish line, right? But maintaining that discipline around underwriting is key for us. That's where I focus most.
You know, a former colleague of mine who passed away used to say that, you know, you can't really train an investor. You have to kind of walk, they have to walk with you, right? So this apprenticeship model is totally 100% agree with that. You have to, it's hard to tell people every scenario because there's so many different scenarios. But we have been trying to formalize some training and making sure, and we're a large organization, so, you know, we have more than 8 people. So what we've been trying to do is say, hey, let's make sure that everybody in the organization is kind of paying attention to what's happening on the macro side. Because a lot of times you get so fixated on your deal or on a specific company, you forget to kind of look up. So we've been doing, our partners within our organization have been making sure to tell people their opinion. And sometimes, you know, it may not be yet played out in the markets and stuff, but they've been telling us their opinion. They've been telling people to start thinking about stuff. And again, since the group, we have a lot of people who've been in this group for a few decades. We've seen a few market, you know, situations. When we saw the prices going up and all the SPAC deals going crazy in 2020, we just felt like, hey, we're due, like we're getting close. We're getting close to a market correction. So that's why we started going out. And again, I think training, I believe any kind of negotiation training is actually just helpful in general for if you're an investor, because our whole job, I feel like, is about negotiating with the insiders, the new investors, the management team, our investment committees. I mean, everything's like a constant negotiation. So again, on the cram down training, just having it, you know, putting some fact patterns together and then asking people to have a conversation around it. It's again, going back to that whole apprenticeship model is the right way to train.
So as we kind of reach the end of this, you've also mentioned, in addition to the training, that you each have, you know, have an organizational role of somebody like a COO, or, you know, I know Echo Health has an operations group, but I want to kind of do a quick, rapid, if you have anything to add on the operational role. I know you've seen those in a lot of different organizations. Ian, did you want to make a comment on what you've seen with people kind of like in a Dave Stevenson type of a role or things like that?
Yeah, look, I mean, I think it's we were talking about this before the webinar started. I think that's a valuable role, not only sort of like touch on sort of organizing this sort of training and best practices aspect, but also being there to sort of make sure that there's good sort of, you know, there's good connection between the investment team and the parent company. And I think if I think about the various sort of, you know, corporate venture clients that we represent, I think, you know, the ones that I think have been around the longest, have had the most, you know, impact in the ecosystem and to their parent companies are ones that have that sort of, you know, operator role at various titles, but really sort of function, you know, as the bridge between the investment team and the larger organization in one way or another.
Yeah, that's great. And just in closing, you know, one piece of advice, Tammy, you want to go first with one piece of advice? And
you know, my big piece of advice is, even if you're just a board observer, don't assume that the management team, the board, or the lead investors actually are paying attention and getting, you know, going to do the right things in these time of economic environments, which means you got to roll up your sleeves and start talking to people. And even if they say, oh, you know, you're being crazy or whatever, don't sit back and watch, you know, the ship hit a wall. You know, like be proactive and sort of thinking about the situation for your company given the macro environment, and just and be engaged. I just feel like when you lean in and you're paying attention without, being a jerk about it, you'll have a better outcome than if you sort of assume that, oh, okay, this is a big mess, but that board has got a bunch of senior people, they're going to take care of it. Don't assume that. I've spent many years as a board observer having to just hit my head against the wall, because I'm going, why aren't these people dealing with this? So jumping in and start talking about what's possible. Anyways, that's my advice. Don't sit back.
Good advice. Thank you. So Dusty?
Yeah, I'll orient on the opportunity, I think, in front of us. I think as corporate investors, we often have an unfair advantage in the kind of insights that we can drive by being as closely connected to our parent companies, as Ian referenced. Having those really close connections is important. We're coming out of an environment in which pricing got so out of control, thanks to, frankly, a lot of tourists entering the space, that even those opportunities where we could drive some of that competitive advantage through our insights and diligence process weren't actionable. We're now moving into a period where that's becoming actionable again. And it's always one of our other first principles. The philosophy at Echo is really look to how we can de-risk the deal based on our connection with the investor, based on the connection with who we're investing on behalf of.
That's great. All right. Ian, final comments?
Yeah, I'll just sort of carry on to what Tammy was focusing on. I do think that really sort of stressing the need in this at this point in time, more so than ever. It's not that there's always a lot of work to do. And you always need to be proactive and communicating and building relationships with your co-investors and with the company. But now's the time to really sort of roll up the sleeves and get to work that much harder. It's sort of it's a real significant uptick in the need to have more board meetings, more informal board discussions, thinking about things more proactively, to get to, what I think we're all hoping for and what the goals are of the CVC community, to sort of, invest in and sort of, nurture the startup ecosystem. And we need to do that in a positive and proactive way. And that begins with, great communication and building good relationships and thinking about, our portfolio companies and the ecosystem, holistically.
Great. Well, thank you very much. And we could go on and on and on about this. There's a great deal of things to learn and to know. And I think one of the common denominators on all this is that the people who've been through it before talk about the value of communicating, negotiating, getting out in front of this early. And I think there's many takeaways from that, and also from learning from each other and having a process in your organization to really level set amongst yourselves and with the other investors around the table, and even your entrepreneurs on what the options are for each company and for the portfolio as a whole. So with that, many thanks to our panelists. We really appreciate your sharing your insights and observations from years of doing this, and hopefully learning over time from various mistakes that may have been made, and moving forward. And sounds like there's also some great opportunities. So with that, I have just a few quick announcements to remind folks of. We have the next series will be on April 12th. These Next Wave webinar series are on the second Wednesday of each month. So you can join that one. That'll be a discussion about the future of automotive venturing, if you will. What's next in automotive venturing? And then after that, well, there's a whole schedule though, and those are available online. So please do share those with your friends, and we'll go from there. If you have any other questions about this or feedback about this webinar series, please do get in touch with us. Our contact information is here. And we have some upcoming events that we hope to see you at the GCVI Summit in Monterey next week. And for those of you in Europe, the GCV Symposium is coming up in London in June, and other events in different geos. So stay tuned with that. And just call your attention also to, in addition to the work that you do to train and level set amongst yourselves on your team, that we have a number of courses through the Institute currently available, a regular schedule on the Institute's website, both for investing related courses and our flagship courses, Landing the Value of Corporate Venturing, which really gets into how do you manage that relationship between the portfolio companies and your parent company, and how do you work as an organization, kind of across that end-to-end ecosystem. So lots to offer there, and we're doing some exciting new work to build on some of these ideas that Ian and Dusty and Tammy have done to make some additional training available for next year. So that is a wrap for this. I thank you for your attention. I hope you got something out of it, and we're looking forward to seeing you in future Next Wave webinars. So thank you, everybody.